So what we're looking at here is your basic trial account to power options. For those of you who are just getting started, I encourage you to take advantage of the 4 steps that are listed here when you're just getting started. You want to make sure that you get access to that quick start guide. You can access some of the tutorials that are available, little walkthroughs on the site, the variety of webinars that are available in the free webinars section underneath the main home tab, not only on the tools and getting used to the navigation of the site, but also the various strategies. And trial members or subscribers can schedule a free coaching session at any time as well. So you want to make sure you take advantage of that if you're just getting started out. Okay, so let's navigate to the portfolio tools real quick. Octavio has a custom spread structure, I'd like to call it. It's sort of a covered call with a bull call debit spread and an extra naked call. He's got 100 shares of Chipotle with a cost basis of $11.0833. He bought a 2021 January 1150 call for $123 and sold 3 contracts of a 1110, 40 points below the 1150 call at $139.65. So one of these short calls can be linked to the stock as a covered call. The other one can be linked to this 1150 call, and we'd call it a bear call credit spread with a 40-point difference, and then one remaining naked call position. Okay, and his Octavio just said a radioactive credit, sort of, in a sense. Yes, but there's no hedge on the bottom. There's no protection. Well, let's go ahead and take a look at this position here. Let me clear that out. Let's take a look at this standard position. 100 shares at 1108.33. One long call at 123.10 with the 1150 strike for January 2021 and an 1110, 3 calls sold, 139.65. This is what we're looking at. A ratio call spread, that's what Octavio is referring to, a ratio call spread with a covered call, so that extra 2-to-1 ratio call on the short side gives him the infinite risk, both to the upside, well, to the upside in general. The downside risk is limited to the total cost into the position, and the max profit is about 15.2% here as well. Okay. Real quick, though, while I'm talking about this, Rob asked a question here. Rob says, is this webinar just about covered calls? Rob, I don't know. This webinar is about whatever anyone in attendance asks me about. This is an open forum Q&A session. I don't have any planned material. I take the questions coming in. The next question after hedging, this ratio spread here, Rob, for Octavio, is going to be related to vertical spreads. And it looks like that question has... I'm sorry, Rob, it's like that question is coming from Will. So we'll take that one next, and we'll just handle the various options questions as they come in. Okay, so we've got infinite risk to the upside. We've got a potential profit here of 15.2% or $29,752. And that's important. Now, that's the max, though. And it's important to notice on this that the max profit only occurs if the stock is trading right at 1110 on January expiration, the strike price of those 3 sold calls. Lower break even, pretty far away at 812, about 300 points, and of course the upper break even is about 250 points away to the upside before we start losing money on the position. What do we want to hedge first, the upside or the downside? Okay, well, if you want to hedge the upside first, you've got to do something to cover this open long call. My apologies, the naked call, the open short call. Cheapest way to do that might be to just buy another 1150 call. Now you'll have 2 bear call credit spreads at 1110 and 1150 with the covered call position. Everything is hedged in some fashion. Nothing is naked. Okay, so we could just change that here. What am I doing? I'm essentially changing the ratio. Instead of a 3-to-1 ratio spread or a 2-to-1 ratio spread with a covered call, we're changing it to just 2 bear call positions. All right, let's just take a look. I'll keep the same price at 123.10, and what that does is it still gives you a peak profit of 17% based on the risk level, of course, and the cost basis. And now the max risk changes to where it's $93,000, but that's back down to the downside. So if CMG keeps going up, you could still make $5,000, Octavio, with this ratio spread, you've negated the naked option which carried the infinite risk to the upside in that case. And of course, you still have the 3 short calls here, one that might obligate you to deliver your stock at 11.10, and then the 2 other short calls that are combined with the 2 long calls as a bear call credit spread, 2-2. Now, am I saying that this is the best one? No. What I'm saying is you probably want to keep the cost down for that long option. You could buy something further out of the money, but then that's going to start to affect the monetary requirement. Where did this $8,000 monetary requirement come from? And that's because these 2 bear call spreads, selling 2 at 11.50, selling 2 at 11.10, buying 2 at 11.50, that's a standard bear call spread with a 40-point strike difference. So that'd be $4,000 to cover each spread. You've got 2 contracts, so that additional monetary margin would come in $8,000 to cover that spread. Probably cheaper than the naked option as well. But what did you give up? Well, you gave up about $12,000. Okay, and that makes perfect sense, doesn't it? Because that's the cost of that extra long call. But what it also does is lock in a profit to this upside where you cannot lose value. You don't dip back into the red if CMG continues to move in your direction, I should say, and goes to 1200, 1250, 1150, what have you. Okay, so that's the way that you'd look to hedge the upside. If you wanted to hedge the downside, you try to look for a cheap put in this case that's half of the maximum profit. So you're probably looking for something around, maybe $90 or $9,000, maybe $8,500, and that would push you way down into, I think when I looked, I believe it was the 1100. Oh, I'm sorry, no, it was the 1010 or the 1015. I think I'll go with the 1005. Now let's keep the math simple. Let's just go with 1,000. This isn't going to protect you that much. Remember, you don't need to protect anything but this 100 shares of stock to the downside. But this is going to cut that maximum profit now in half. Still have a guaranteed profit to the upside if it continues, but you've limited the max risk to only 2% to the downside. Looking like a butterfly position, essentially, is what we've done here. But yes, we started off with a max profit on your original position of $29,000 if and only if the stock was trading right at 1100. I'm sorry, yeah, 1100. By adding an extra long call at the existing long call strike, your 1150, you create 2 debit spreads. You need an $8,000 margin in that case, but that gave you a position that still gave you $17,000 max profit at 1100 and still gave you a profit here to the upside if the stock really took off and continued to move up in price. Then if you wanted to hedge the downside, this put might be too much. I might be willing to take a 5 or 6, maybe even an 8% risk to the downside, and maybe going into those 900s on the put, paying less costs, keeping this maybe up to $10,000, $12,000. But that's what I would consider for hedging this position in that case. Adding in the extra call, and you can play around with the numbers, say what would happen if I bought a further out of the money call here. So you'd have a 40 strike bear call credit spread between 1110 and 1150. And then maybe another bear call spread, say between 1110 and 1175. But no, that's also going to increase that monetary requirement that you need to be in the position. But it would still give you this type of structure with a max profit to the upside if it takes off. The peak of the profit still at 1100, but we haven't really adjusted the downside risk. And as we mentioned, right now we've got the break even all the way down to 935. So you've got a really nice cushion there in that case. That's how I would look to hedge the infinite risk to the upside and consider hedging the risk to the downside as well. 2% might have been too low of a risk. I might be willing to take a lot more risk in that case as well, just to not take too much away from the max profit based on your expectations come January for the position. Okay? Oh, heavens no. Okay, there we go. All right. Okay. Oh, Sam says, the fear is here. Maybe that's too much money into one stock. And Sam comments here that he says that looking at my bull put credit spread, I think my bull put credit spread here on Apple, oh, sorry folks, hold on one second. Here we go, okay. All right. Okay, sorry, I think my Apple bull put is a little bit better investment. I'm in it for a month or two. It'll make the same profit like Octavio's trade on investment. So he's looking to still make that 15 or 17% return on an Apple bull put on what his investment in that position. Okay. All right. And Dan says the stock is way out of reach. Yeah, some of the stocks that might be discussed might be a little bit higher as well. Okay. Yeah, Octavio, honestly, I'm sorry you're not going to be able to do that with the structure you already have. I looked into it. There's no way that I saw, there's no magic ratio spread that exists right now with this structure you already have of a naked call being open and your one contract here. What Octavio mentioned is hedging the CMG for no out-of-pocket cost. No, you're going to have to pay a cost to hedge that upside. There's no other way to remove that infinite risk without buying more stock or buying a call option to cover the naked call. And then if you sell more calls to try to pay for that, or you sell puts to pay for it, that's going to cause a monetary requirement. With the structure you have right now, I did not see any way. There's no magic butterfly ratio spread, another ratio spread that I can see that will cover the infinite risk to the upside without an out-of-pocket cost. Okay, that's what I see there as well. Okay. Dan says, what is this strategy called? Now, this one, when I added the second one in, what it really boils down to, let's take this off and take this to 2, okay? What this really is, oh, no, I'm sorry, let me clear out the stock. My apologies, Dan. Here we go, one last thing here. What this really is a bear call credit spread. 2 contracts of selling the 1110 lower strike and buying the 1150. Sam, of course, has pointed out that with the stock at 1116 right now, Dan, that naked call, that extra contract we had before we added the 2 and 2, that's the naked call that's in the money. And then on top of this, there was a covered call. Okay, originally, what Octavio has, Dan, is a ratio call spread, which, as we all saw, carries infinite risk to the upside. He sold 2 1110 calls, bought an 1150. And then he did a covered call beneath that, sort of a ratio covered call. But one of these calls outstanding is still naked. That's what we look to hedge. In order to hedge a naked call, you need to pay out of pocket to buy an extra call to cancel out the obligation. Or, I'm sorry, to cancel out the infinite risk. You'll still have a potential obligation at 1110. The other way to hedge it, Octavio, is buy to close one of the extra shorts and just go back to the covered call in a 1-to-1 bear call spread. That's it, to cancel the infinite risk. But you've got to buy to close it out of pocket. There's no butterfly I can think of, ratio butterfly, ratio spread, reverse ratio spread, that's not going to cause a debit because you're going to have an extra long call in place somewhere to cover that naked short call obligation. There's no magic that we're missing. Okay, that's it. So Dan, that's what the strategy is kind of called, according to my apologies, according to Octavio. Sorry. Okay. I'm sorry. This one's Ryan. It looks like it's next. And I've got very questions. Edison, you're in there, and I'm going to take your comment with Deborah. Looks like it's married puts, but I've got to get to Ryan's right now. He's been on here for a while. Ryan says, so I'm pretty new to this. I bought a call NIO. Let me go back to here. Okay. NIO at 650, strike for 717 expiration. July 17th, NIO 650 call. And sold a call of 6, the same expiration. What should I do to correct this? Okay, so you entered a bear call spread by mistake, I think, in this case. I don't know if Neo just jumped today or what happened. Oh, no. Okay. All right. Let's go ahead and submit that. So I don't know what prices you got, Ryan, and I don't need to. Okay, but here's the situation. You're in a deep in the money. You bought, am I looking at this right? You bought a 650 and sold a 6. Oh, yes, yes. So you're in a deep in the money bear call spread. Let's see here. Let me get the scrubber going so we can look at this correctly. Here we go. That's about as far as it goes. It doesn't even go back down all the way to 6. Where max profit trails off if the stock is trading below 6. This is strange, though. That is strange. With the current numbers that I have here, midpoints are weird. But the deeper in the money, and I got... okay, yeah. So if this was done at a credit, man, you don't need to do anything. You can just let it expire. It's kind of strange. At expiration, if the stock is above both strike prices, your broker will buy shares of stock for you at $6.50 and sell it at $6, and you'll pay a debit of 50 cents. But in this case, according to the current numbers, which probably aren't yours, Ryan, the cost is $52.50, which is greater than the maximum risk and the difference in the strike prices if I got filled at midpoint. So that's probably not realistic. You probably have a debit here of maybe not that high based on these midpoints, but maybe a debit of 30 or 40 cents. If this is accurate, if your credit that you received on this in-the-money bear call credit spread, which is a no-no, is greater than 53 cents, I'm sorry, greater than 50 cents, well, leaving it alone, you're guaranteed a profit of $2 to $3, even if the stock goes up to $40 or $50 per share. And you'll have a higher profit if it drops below 6. But that's probably not the case. Some of the things you can do, the obvious one is just buy to close the call now. If your goal was to just be in a long call, July expiration, at the 650 strike, and you're willing to pay $8 or $9 for it, that's fine. You sold this for maybe $8.90, $8.95. You can potentially buy it back Monday or so for probably about the same price unless there's a large gap over the weekend, okay? And this is, Debbie says NEO went up a huge amount last week, all right? And of course, Sam's in NEO as well. All right. So in this case, that's what we're kind of looking for in that situation, all right? And just buy to close it. Now, of course, it's not fair to me because I have it here, but let's say I originally sold it at $8.90. And now I got to go back in. Oh, sorry, wrong expiration there, Ryan. I got to go back in and buy back this 6, and I'm going to get the worst possible price. I'm going to put it in at $9.20, okay? So what does that really do? Well, that leaves me with the long call you wanted. All I did was add 30 cents, 40 cents extra to the cost. So I'm still in the long call with a cost basis of $8.82, no obligation on the short option. But again, if your net credit on that was over 50 cents, you're in a no risk. Your maximum profit's only going to be about $2 or so per contract, or 2 cents per contract, I should say, in that case. But if you got 52 cents net credit, as I just showed here, which I highly doubt, but if you did, it's a no-risk spread where normally anywhere above $6.50, you're just going to make 2 cents, but as it drops, you're going to be able to make more on the position. Another thing that you could do here is, depending on, I wouldn't recommend it because the stock price is so high above where you are. I think what you need to do is buy to close this call. You shouldn't take too much of a hit on it. And if you do take too much of a hit, because let's say you originally sold this for $4, now it's going to cost you $8.90, Ryan, to buy it back. You did it a week or two ago. Then still, you want to buy it back, but then you can sell maybe a 15 or a 17 strike call against it to hedge some of that extra cost you just took on the position by buying to close the short call. I'm not going to recommend anything crazy on this position, such as a broken wing butterfly or anything along those lines, or adding an extra call up here, because it doesn't negate the fact that you're short on the 6 strike call. Any butterfly I try to do by buying an in-the-money call, the max profit's still not going to occur until it's at 6, and it's going to put him in a loss zone, a higher loss zone because of the higher cost of the call. Doing a broken wing outside butterfly in this case isn't going to solve the problem that he's still short the 6 call, okay? That doesn't really change the way things go. It leaves the upside open, but now you've got extra cost into the position of another $157. You've kind of got a synthetic position here, looking at sort of a bear call with an extra long call that does leave the upside open. It's not bad. Doesn't change the fact that you're still going to be obligated to deliver shares of stock at 6. Your broker's going to buy them at 650. You're going to take that 50-point loss between the two, and then profits made here only if the stock's above 1670. Okay, so that is an option. It gives you a type of repair on this, but now adding more contracts and trying to ratio this doesn't solve and negate the problem of this. This is your problem here. got to get rid of that. If your goal was to be in a long call, you've got to get rid of that short position.